Well, now that the economic tide has turned, the challenge for IT organizations is to ensure pragmatic cost control actions, rather than driving irrational cuts in core business and IT capabilities. Well, with IT consuming a larger portion of enterprise expenditures, it is imperative that executives quickly implement a better way to measure, value, and prioritize IT initiatives. To help balance risk and innovation, IT executives must develop methods that enable business leaders to make informed choices about their business and IT investments and facilitate value-based discussions. This involves managing IT products and services as investments, demanding a return on quality, functionality, and availability. By helping business leaders to make value-based decisions, IT executives will simultaneously maximize the value and return on IT resources, as well as help improve the deployment of short-term and long-term strategies and tactics. IT portfolio management is a disciplined and structured approach of continuous, repeatable, and easily sustainable processes designed to map business requirements to technology decisions. Using a financial metaphor as the foundation, IT portfolio management enables organizations to categorize, evaluate, prioritize, purchase, and manage technology assets such as hardware, software, and people. It also enables organizations to align IT spending related to those assets and projects with current and future business needs to achieve an acceptable balance of risk and reward. A personal portfolio, for example, might contain real estate, securities, mutual funds, cash. An IT portfolio would contain physical hardware and software assets, IT projects, IT staff, and business processes in the form of lifecycle templates and engagement models. The items in a portfolio are typically classified according to the following three factors. The first is the level of risk versus expected benefits or value. This typically includes some feel for the magnitude of the investment being made, here denoted by bubble size. The second is current fair asset value. What is the investment worth at any given point in time? And the third is expected life cycle. What is the return on project investment, and when will the investment be expected to pay off? Companies using the IT portfolio management discipline pursue two main goals. The first is balancing risk and reward. The portfolio management approach enables companies to deploy a consistent decision-making process that systematically weighs risks and rewards for each critical business and IT decision. Strategic alignment is another important goal for portfolio management. Typically, an organization should employ a bottom-up or top-down approach, or a combination, to systematically align IT value with corporate objectives. For example, if the business strategy emphasizes growth, IT spending patterns should reflect increased support for business or market development. The balanced scorecard technique combined with classic project performance metrics is an effective approach for exposing value while managing the portfolio across a range of conflicting business objectives. Items in the IT portfolio fall into two broad classes, assets and projects. The IT asset portfolio represents the current state of assets in the organization and includes the following components. Application assets, such as supply chain, ERP, CRM, email. This category includes both off-the-shelf and custom-developed applications. Data and information assets. This includes customer data, product catalogs, corporate data, process information, and documentation. The third category is infrastructure assets, such as servers, storage, networks, desktops, phones, etc. Next, operations and service assets. This includes network and system automation, process definitions and flows, help desk, command center, etc. And finally, human capital assets, such as IT staff, competencies, knowledge, skills, experience, and the remaining resource capacity. We have three investment categories that define the primary goals of the IT assets and projects. The first category we call Run the Business, or RTB. This is about keeping the business operational, about keeping the lights on. The second category of investments we call Grow the Business, or GTB. This has to do with expanding the business within its current scope of operations. And the third category is what we call Transform the Business, or TTB. This is about breaking into new markets, for example. Run the Business RTB investments involve keeping the business operational, as I said before. Items falling under this category often include utilities, maintenance projects, disaster recovery initiatives, and other operational activities. Grow the Business, or GTB investments, are made to expand the organization's scope of products and services. Investments here could be for upgrading software, adding incremental capacity, or developing skills within the staff through additional training or other efforts. Transform the Business, or TTB investments, involve moving into new markets. Sample TTB investments include new business ventures, mergers and acquisitions, new products, application package additions, outsourcing, or the hiring of new employees with new skills. But the overriding goal should include a continual focus on reducing the cost to operate core, non-discretionary run-the-business assets. These are the price of keeping the lights on, while continually rebalancing Grow the Business and Transform the Business assets in a way that reflects the strategic goals of the organization. Well, IT assets, like assets in a personal portfolio, should be managed with a buy, sell, or hold mentality. We find that many organizations, like many investors, are good at buying, but have difficulty in determining when to sell. In this case, when to move away from certain technologies and applications. IT portfolio management is the only method by which organizations can manage IT from an investment perspective. This means managing in line with the current state of the business and with a continuing focus on value, risk, cost, and benefits. Companies that have adopted IT portfolio management maintain exemplary records of continuous IT efficiency improvement, with some organizations reducing costs by up to 30% while increasing value by 2 to 3 times. In summary, IT organizations must adopt practices and principles that continually align business pressures with demands on the IT portfolio. Portfolio management is simply the most effective strategy for achieving sustainable IT and business alignment. IT organizations that fail to employ portfolio management risk sliding into a trap of business as usual, falling behind the competitors that exploit this highly effective approach.